morning, and good afternoon to in-house counsel and in-house legal professionals from all across North America and the world. Welcome to In-House Connect. My name is Shai Mahani. I'm the CEO and co-founder of In-House Connect, and I'm thrilled to have you here with us today. Thank you for spending, once again, your breakfast time or your lunchtime with us. And special thanks to our wonderful sponsor, the In-House Connect Hub, which I'll tell you more about in just a few minutes, and our fantastic presenter today, Cara Bradley, who's going to teach us financial statement basics for in-house counsel, navigating the language of the business. So this is our 78th event of the year, and I'm wondering, are you here for the first time, or have you tuned into an IHC webinar before? So it looks like we have about an 80-20 split of returning to new, so 80% returning. Welcome back. 20% new. Welcome to In-House Connect, and I hope you enjoy today's program. Today's program is Financial Statement Basics for In-House Counsel, and our presenter, our wonderful presenter, who is really volunteering her time out of her busy schedule to teach us financial statement basics. She is Cara Bradley. Cara is the Deputy General Counsel of Everbridge, a global software company that empowers enterprises and government organizations to anticipate, mitigate, respond to, and recover stronger from critical events. Cara manages a legal team that handles commercial contract negotiations, public company compliance, human resources, merger and acquisitions, global compliance, and business strategy for Everbridge. Again, great topic, super needed, really strong interest, and a wonderful presenter. So without further ado, I'll turn things over to Cara to get us started.
First of all, I just want to start by thanking everyone for spending a few minutes with us today to talk about this topic that I think I've always thought was important in order to be kind of a good trusted advisor for anyone that works in-house. And so we'll talk a little bit about some introductory topics around financial statements that kind of help position that for you. All right, so what are we going to talk about today? What are our learning objectives? We're going to talk, start a little bit at a more high level, foundational level. Think about what financial statements are and what they're meant to capture and report on. We'll talk a little bit about basic terms, some foundational terms that are kind of part of any language of understanding financial statements. Next, we're going to cover a little bit about accounting principles. How financial statements are compiled and reported sometimes don't make much sense to someone who's not familiar with the principles of financial reporting. And I think for me, understanding some of those principles is helpful to explain kind of why things are done the way they are. Next, we'll do a quick overview of the three main financial statements. So that would be your balance sheet, an income statement, and a statement of cash flows. We'll look at some samples and think about what each, how these are different and what they are each meant to represent. And then we'll quickly close out with highlights of what financial statement footnotes cover, what MD&A covers, and then wrap up with how in-house counsel can use their better understanding of how to read financial statements and financial statement analysis to help make your everyday job a little bit easier. What are financial statements? What are they used? Who cares about them? Really, financial statements are a common way of reporting out how a business is performing and what they own. And the idea is that they are consistently prepared under a set of measures that make them comparable between companies. The idea is to measure, financial performance over time and to have some sort of consistent reporting. And the idea is by, looking at that data and following that data over time, you can help assess the health of the business. Financial statements are used by, in all sorts of different ways. Investors in a business who are trying to understand whether they want to invest money in a business use financial statements. Banks who are trying to assess whether they're using whether they should loan money out are using financial statements pretty frequently. Anyone who's really trying to assess the business's performance are using financial statements to help understand, what the status of that business is, and then often to try to project into the future where that business may be going. Now, financial statements, I think, a little bit are kind of a corollary to, if someone asks you as a lawyer, what is the law? It's really not that simple, particularly like in a common law jurisdiction like we live in the United States. Financial statements are similar. There are kind of regulatory bodies that help assess, standards that are consistent across presentation and preparation. And then beyond that, there's kind of industry-specific guidelines. And then there's kind of common practices that all affect, how financial statements are prepared. The most common one that you'll hear about, particularly for US-based business, is FASB. So FASB is it's an independent standards board. I think about it kind of similar to like a uniform law commission. And they have, call it, oodles of standards for how financial reports or how financial accounting should be created and reported. They produce standards that are called kind of ASC standards. So if you see a reference to an ASC standard, it's something that is promulgated by the FASB. That's again, think about it. That's probably the most important regulatory body for the United States. That covers basically all financial accounting under GAAP, regardless of whether the company is public or not. Now, if you work in a nonprofit sector or for a government agency, there's a slightly different version called GASB. And so we're not going to cover nonprofit accounting or kind of government accounting today, but the idea is kind of the same. A nonprofit agency sets forth standards, and there's a little bit different on how reports are compiled and presented, but a lot of the standards and the principles are the same between FASB and GASB. If you work for an international company or a company that might be headquartered, particularly more in Europe, you may also be preparing financial reports under IFRS. That's an international financial reporting standard. Again, not that different from a FASB standard, but how some of the presentation works and some of the disclosure is a little bit different. And again, but that tends to be more companies that are not headquartered in the US or traded on a US stock exchange. And then the last kind of major regulatory agency that we look towards is the Securities and Exchange Commission. The SEC is really covering regular disclosure of financial reports for companies that are listed on a stock exchange in the United States. Many attorneys who may be familiar with doing deals or doing equity raises, or are looking at SEC reporting now, may be familiar with Reg SK. Reg SK has a lot of details about what needs to be reported in SEC filings that are kind of non-financial measures. Reg SX is the SEC rules and regulations that cover the form and the format of accounting standards generally. Next, we'll just talk about some kind of foundational terms that are used really across any set of financial records. So we're talking today about financial accounting, which is really how financial statements that are used often with external parties are compiled and presented. Financial statements are almost always prepared on an accrual basis. And so what that means is that it kind of follows some of the accounting principles that we'll talk about in a second. But often when you recognize a sale may not follow when you receive cash for a sale. And there is a difference between accrual accounting and cash-based accounting. So accrual accounting has a set of measurement principles about when you recognize revenue, when you report an expense, when you recognize an asset or a liability. And again, with the idea being to make financial statements comparable across different companies. Cash accounting just follows the money. So most of the time, if people are talking about tax accounting is often done on a cash basis. And so when you record something often depends on when you receive the money or when you pay the money. But the idea that we're in kind of the world of accrual accounting is an important one to remember. And then from a very high level, revenue and expenses, those are the two main items that we cover on an income statement. Revenue is the income that you generate from products and services, from selling products and services. We'll talk a little bit more about how and when you recognize revenue. And expenses are revenue is money coming in, expenses is money coming out. So expenses are the costs, that you're recognizing, that you're paying to operate the business and generate revenue. And then on a balance sheet, your three main terms to know are assets, liabilities, and equity. So assets are things that you own, things that the company can kind of claim ownership over that hopefully will generate future value. Liabilities are any debts or obligations. And equity is the residual value that's left over after you've take away your liabilities from your assets. It's also really kind of what you think about is kind of a shareholder value, but a shareholder book value as opposed to a market value. All right, so next we're going to cover accounting principles and kind of the the high level view on how accounting and financial statements are viewed. So first off, revenue recognition. Revenue is recognized not necessarily when cash is received. Revenue is recognized when a transaction occurs. And again, depending on your industry, depending on what's being sold, can be quite complicated sets of rules around how revenue is recognized. This is a particular area that gets really pretty specific depending on the industry that you operate in. The next principle is the idea of conservatism. So you almost always have to record your losses before you record profits. And so particularly if you're thinking about the principles generally kind of delay recognition of revenue or delay recognition of a particular gain and more accelerate recognition of a loss or the recognition of an expense. The idea being that a little bit of, don't count profits before you have them. But in general, kind of a theme around financial accounting is a conservative approach to how transactions are recorded. Next, we've talked about this already, consistency. Right? The idea is that accounting methods and policies are applied consistently. Now, methods and policies can really vary differently depending on the nature of the business, what you're selling, kind of what your balance sheet looks like. But the idea is that if you look at an income statement from 5 companies in a software industry, that you should be able to readily compare those, the financial metrics and the financial ratios, because they are using similar policies and procedures to create those financial statements. Next is the idea of cost. And so transactions are recorded at cost since you know what things are paid for. So this often more applies to assets that you're paying for. So things like property, plant, and equipment, or a building. You don't, when assets are recognized on a balance sheet, you don't adjust the value of those assets based on a market value. More typically, you have it recorded at a particular historical cost. And so, this can be a large gap between something that you have on a balance sheet versus what kind of, how a company is valued. But again, it kind of harkens back to the idea that financial statements tend to take a more conservative approach to stating what a company owns. Next, financial principles talk about reliability. And so transactions, there can be a lot of money to be made and sold based on, how a company's financial reports are sent out to the public. But financial reports need to be reliable, and they need to be, a summary of transactions that have actually occurred using evidence that exists. Again, this is particularly both for private and public companies where the role of auditors often come into play. And so, companies are responsible for preparing their own financial statements, but auditors are kind of that third party that come in, test and verify whether, whether the transactions that are reported in those set of financial statements are accurate and correct, and whether they can be verified in some cases using external evidence. For those who may be particularly working in public companies, sometimes we get asked by our auditors to help kind of confirm accounts receivable balances or kind of confirm about the existence of side letters related to any commercial transactions. And so again, that's the idea of an auditor going into a books and records and trying to have some type of third-party verification or consistent way to prove that evidence exists that financial statements are accurate. All right, and then the second set of accounting principles, the next one is full disclosure. You can't hide information, right? You need to include all the information in readers' understanding of financial statements. There are lots of rules and regulations around how statements are compiled and reported, but if there is other information that would particularly affect a reader's understanding of how to assess that data, it also needs to be included, most often typically like in a footnote format. Economic entity, again, this is just more kind of respect to corporate entity. And so record transactions and reflect everything that's relevant for a particular entity. And then wrapping up, the matching principle. Matching is, again, really important when you start to look at income statements. And so the idea is that revenue should be matched with an expense. The same principle also applies kind of for spending money. And so if you prepay for something that you're going to use, like a service in the future, you don't record that expense until you actually kind of utilize that service. Materiality, again, if anyone, for those of us who work at public companies, that might, it's a term that gets thrown around a lot. And, materiality applies regardless of whether you're a public company reporting to the SEC or not. And the idea being that if there is something that will affect a user's decisions around those financial statements, in the SEC public company world, it's often, is the investor's decision be affected by whatever information you decide to disclose or not disclose? The idea is you should generally be disclosing information if someone outside of the company would find it useful. And then finally, kind of time periods. This is pretty straightforward. Financial statements should reflect kind of similar time periods across time. Most typically, like in a private company setting, you're preparing financial statements, external financial statements on an annual basis. In a public company setting, or for larger companies, you're more typically reporting interim financial statements on a quarterly basis, and then full financial statements on an annual basis. That piece is governed again by SEC rules. Under the SEC rules, you don't have to have quite as much financial disclosure on those interim periods, but the year-end periods, you need kind of more fuller disclosure available. All right, I'll take a quick pause there. Jai was going to run a quick poll for us.
Yeah, and we have, so thanks, Cara. So we have a question. Does SEC rules apply if you're not a publicly traded company?
SEC financial reporting rules
Yeah.
don't only apply if you are publicly traded. Again, sometimes people get backdoored if they're a foreign private issuer or you have publicly traded debt, but generally not. Regardless of whether you strictly need to comply with those, often banks or investors, venture capital investors, private equity investors have certain expectations of what financial statements should look like and prepare. And so even sometimes if you are not strictly required to follow those rules, there may be an expectation by other parties. Where you don't typically see is, where SEC statements have a lot of information around management discussion and analysis and risk factors and some things that are a little more unique to public companies. You won't see that more often in a private setting. And again, when you think about companies that are going public, that's why it can be such a big lift on a company to start thinking about and publishing that information.
Got it. So turning to our poll question, which is Ellen Chagrin, I guess, is in fact a test. It's a quiz in disguise. We're bringing you back to grade school. So the question is the method of accounting that recognizes revenue when it's earned and expenses when they are incurred is called. And the answers are income basis, managerial accounting, accrual basis, or asset basis. And before I turn to the results, quick rundown. Tell us one more time real fast. What is income basis? Is that when the income is like, I guess you tell us what's income basis?
That's made up. It's not
okay.
So
all right. Well, 22% of our have said that it's income basis. So you are wrong, unfortunately. Managerial accounting, what's that?
So managerial accounting is a little bit more around internal reporting that you do. And so there's a whole field of managerial accounting. It's often more around kind of how costs are managed internally, and particularly when you think kind of about budgeting and kind of internal reporting.
Got it. And then asset basis is just, was that made up too?
The basis is a little bit of a tax concept. So, what is the value of your asset?
All right. And so the correct answer is accrual basis, which 76% of our audience have gotten correct. So congrats to you. Gold star for all of the 238 people who answered that question correctly. All right. Back to you, Cara.
All right. So next we are going to look at these three financial statements and talk about them each in a little bit more specific manner. All right. So first up is the balance sheet. Right, the balance sheet, if you think about it, is a snapshot in time. And so balance sheets are always prepared as a specific date. And so most typically, I think the most common year end for people to have is December 31st. Theoretically, you can pick any date for your year end, but most companies will select a fiscal year end that corresponds to the calendar year. Balance sheets have kind of classifications of both assets and liabilities. And so, the two big classifications are whether something is current or non-current. And you can tell which things are current because the things that are, asset balance sheets are organized with the things that are most liquid at the top. And then same thing with the liabilities, the things that you owe first are listed first. And so anything that is cash or a cash-like security or anything that's expected to turn into cash within a year is considered a current asset. And so the most common ones you'll hear about are accounts receivable. So accounts receivable are if you sell something to a customer and they haven't paid you yet, right? That is the debt that they the debt that they owe to your company and the cash you expect to collect. Inventory, again, if you are selling physical goods, are the goods you have in your possession that you intend to sell. On the non-current side, again, things that you tend to hold on to for a longer period of time. And so again, they're a useful life greater than a year. The most typical non-current assets are property, plant, and equipment. Some of those assets, have to be depreciated over time. And so what that means is, you don't get to kind of keep that full cost on your balance sheet over time. There are kind of predetermined amounts depending on the useful life of what that asset is that you deduct from the value of the asset over a set basis. The other thing to think about when you're looking at a balance sheet is tangible assets versus intellectual property. And kind of the same thing applies on the liability side. So when I think about things that are tangible, it's stuff I can pick up or stuff that I can get an account statement and tell me that most things that are tangible assets are easier and more recognized on a balance sheet. So things like cash and AR and stuff that you can touch. As attorneys, I think we also think a lot about intellectual property, which is a non-tangible asset. And so, when you think about the value of a patent or the value of a trademark, kind of a reputational asset, because those are kind of intangible assets that are hard to value and don't have kind of a recognizable amount to put on a balance sheet when they're originally created, those never come onto a balance sheet. The one exception that there are some small exceptions, so you can capitalize kind of like filing costs of a patent or a copyright. And so again, those are often like a small amount compared to what you're spending to produce that patent. But there can be small amounts that are capitalized for registered IP. The other piece that also gets capitalized is goodwill. And so goodwill is really only created in the context of merger transactions. Another slide about that, we'll talk about quickly about goodwill later. All right. And so again, this is what a pretty typical balance sheet looks like. For the purpose of this presentation, just pulled financial statements from Apple because they're relatively recent and they have a pretty simple presentation. So again, any balance sheet has to balance. And so the top half of your assets have to equal the same amount as your liability and your shareholder equity put together. Your top part of your assets are your current assets. So again, these are things that are either cash or going to turn into cash, hopefully in the next year. And then there's a subtotal for what your current assets are. Balance sheets, again, are always presented to occasionally 3 time periods. And so you can always kind of compare what was on a balance sheet from the last measurement period to the current measurement period. Some of your accounts on a balance sheet are presented net. And so when you think about like accounts receivable or property, plant, and equipment, those are the two major accounts that are presented on a net basis. And so what that means is, when you take an account receivable from a customer that owes you money, we all know that not 100% of the customers are going to pay us 100% of the money that they're obligated to pay. And so, there is a process where your finance team has to assess the valuation of those AR balances, particularly, if they have balances that are pretty aged and have been trying to collect for a long time. And so, an offset to your account receivable assets is called an allowance for doubtful accounts. And so that's kind of your best estimate of when of how much of those AR accounts you think are not going to be collectible in the end. It's the same idea on property, plant, and equipment, but a little bit different in that where we talked about, that those assets are recorded at a historical cost, and then they're depreciated over time. So again, a depreciation is a non-cash expense that is meant to cover that, some of the assets that are PP&E are going to, go down in value. And so this amount is presented as a net amount from the historical cost less the depreciation. So top half of our assets, again, most liquid to the least liquid. And then the bottom half, or the next section, are your liabilities. Again, you start with your current liabilities, so things you owe to other people and that should be paid in the next year. So things like accounts payable, kind of the opposite of an account receivable. So if you purchase something and you owe another company that money, that's an AP balance. Deferred revenue, again, is an important number to pay attention to. And I guess, particularly in some businesses, particularly if you're selling subscription services or services that are performed over a period of time, or if you're delivering goods over a period of time. Companies that sometimes may be paid upfront for those services, but they still have an obligation to provide those services over time. And so you can't count that cash all as revenue when it's received. Some of it becomes, the cash comes in under current assets, but then you have to have an offset as deferred revenue. And so as you provide those services over time, or as materials are delivered, then something kind of gets deducted from a deferred revenue balance, and then becomes revenue that goes over to the income statement. And then, so again, current liabilities, non-current liabilities. Your non-current liabilities most often are debt or debt-like instruments. And then the last balance is shareholders' equity. And again, this is reported at a historical cost, not necessarily how the market values the equity. You have both, again, par value, which is often related to whatever you set the par value of your securities under, depending on how your certificate of incorporation is prepared. And then anything above that par is called additional paid-in capital. Regardless, I think that those two numbers are typically added together. And then one of the last items on a balance sheet is called other comprehensive loss. This one, is not an account that people pay that much attention to. It's most typically, unrealized gains or losses that in some cases need to be recorded, but are not in the income statement. Most typically what you'll see, for these are, if you have gains or losses related to foreign currency hedging, or securities that are classified as available for sale, then sometimes, as opposed to just being an income statement, it's presented in a balance sheet matter until the loss or gain is realized. So what are not on a set of financial statements, or what are some of the things that are not recorded on that balance sheet? So contingent liabilities, and again, there's kind of another whole set of rules that we could have a much more deeper conversation on that talk about when you record a contingent liability. Almost any kind of lawsuit that you may be subject to often falls into a contingent liability category. And so those are the idea of, you may know what a liability, you may be able to estimate a liability, or maybe you can't, but you're really not sure whether you're going to have to pay that liability or not. And so, when it becomes, both, probable that you'll have to pay that liability, and you can also estimate that liability, then you have to record that as an expense in your financial statements. And so again, for those of you who handle any litigation matters, if you talk to your finance team, you may be often asked to estimate whether you think you'll have to pay out any money for a lawsuit, or whether you receive money from a lawsuit, and then kind of questions around how probable is it that you may win or lose a particular proceeding. Again, if it applies to both public and private companies, if you ever get asked by an auditor to prepare an audit letter or a litigation letter, often auditors kind of have, again, they're trying to verify information that may or may not be part of your financial statements in regards to contingent liabilities. there's a whole practice and procedure around that. But what they're really trying to understand is whether any contingent liabilities are properly accrued, or sometimes they just need to be disclosed, depending on where they sit. On the other side, contingent gains. So if there's something you think some gain you may have, and so again, think about it, if you are suing someone else and you may potentially recover that money, you're not allowed to record that money or to record that gain until it's realized. So that's a good example of kind of the conservatism principle, where you may have to record a liability, when you think you're going to have to pay it, even though you're not 100% sure. On the other side, you can't record the gain until you basically have cash in hand. Another kind of broader category that are not captured in financial statements, but are often part of footnotes, are commitments. And so maybe companies make all sorts of long-term commitments. You may make a commitment to build out a new building. You may have long-term lease commitments. Sometimes you have purchase supply commitments to buy materials from a supplier for X number of years. In some cases, most of the time, those commitments are reported in a financial statement footnote, but aren't going to be necessarily part of your balance sheet. All right. So moving on to the income statement. So where we were looking at a balance sheet that was a snapshot in time, the income statement covers a period of time. And so most often where we're talking about here is, it'll cover a year's worth of activities. And so the equation to think about here is that, the revenue or the money you're taking in less your expenses is equal to your net income or loss. Your income statements, again, are supposed to be a measure of your profitability, whether the company is earning money or losing money. And again, the accrual method of accounting, where the timing of how things get recorded is really important when you're looking at an income statement. Most often, if you are, again, it's a little bit more centered on companies that are, companies that are publicly traded, if you have analyst coverage, but it also the same thing happens if you are looking for external funding from, basically any other company that's going to give you funding. Often what is, most being used is, someone is taking that income statement and then applying some assumptions about how the company is going to operate in the future, or where they may be able to boost revenue and limit expenses, and they're kind of applying then assumptions over time to come up with what's considered a discounted cash flow of the value of that business. And so when people are doing the work to come up with a business valuation, this is the statement that has the most significance. So two of the bigger concepts again with income statement are revenue recognition and cost of goods sold. You could do whole couple hours on revenue recognition. And again, revenue recognition really can differ depending on what you're selling and the method of when you're delivering goods. But when we think about it at a really high level, how and when do you recognize revenue? And so, first you have to, identify a contract. That doesn't necessarily have to mean it's a written contract, but something that it agrees to sell goods or services. Next, you have to identify what are the performance obligations. And so again, I work at a SaaS company. We sign contracts all the time, and typically we sell things on a subscription basis. And so we sign a contract, and the company then has an obligation to provide access to that hosted software over a certain period of time. Next, you need to look at the transaction price. What is the cost of, or yes, what is the agreed upon value that's getting exchanged between the parties? Sometimes that's easy. It's part of on a quote. It might be on a purchase order. Sometimes that's harder to determine. Maybe it has some price that can differ based on when things are delivered, price that can differ based on cost of material, or even kind of price that can be contingent depending on how and when a project is completed. But once you know kind of what that price is, then the price has to be allocated across the services that are being sold, that services or goods. Again, in some places that's easy. If you're selling a widget to someone, you get money, you give them the widget, that's your sale. In other cases, it can be a much more complicated transaction. If you're thinking about building out a building, you may pay someone, $50 million to build a building, but there may be milestones of, this part of the building has to be done first before the second and the third part. And you have to allocate a piece of, based on the relative value of everything that you're selling, you have to allocate the transaction price, across all of the elements of the arrangement. And then finally, once you've gone through those first 4 steps, when a company has satisfied that performance obligation, that's when you can recognize revenue. And so again, your finance colleagues who are helping figure this out, this is really important, where you stay in step with your finance and accounting colleagues who are helping work on revenue recognition, because often when we're drafting contracts, some of the words matter, and some of how maybe shipping terms or the description of what is being sold, a lot of that can affect how revenue is recognized. And again, can be really specific to your company, but from a high level, this is how we think through it. Much simpler on the other side are cost of goods sold, or called COGS. Your cost of goods sold are things that are directly related to whatever it is you're selling. And so materials used to produce those goods, labor used to produce goods or services, and direct overhead are all go into cost of goods sold. And we'll see why you differentiate between a cost of goods sold versus an indirect expense. So this, again, is the income statement that relates to the balance sheet we just looked at from Apple. This is their year-end income statement. So you'll see 3 years presented. Each of these years captures all of those transactions related to that entire period. Again, it starts with what it is that they're selling, products, the products or the services that they're selling. When we talked about an allowance for doubtful accounts for understanding what the valuation is of your revenue, some of that gets netted out of these numbers. And so that's why you see a net sales number. But your first couple of lines of an income statement will always be what is the revenue that's been recognized over that period of time. The next piece is then your cost of sales. And sometimes these get differentiated in different line items. But again, those are the items that are directly sold for products or services. Your cost of sales, subtracted from your net sales, are your gross margin. And so your gross margin, is a measure of, is often viewed as a percentage number. So your gross margin is a measure of how profitable are your selling activities. So are the things that you're selling, are you making money off of it before you consider any other operating expenses? And again, how those metrics are measured really vary by industry, but it's something that's very commonly compared between companies. These again are called often above the line. Once we talk about things that are above the line versus below the line you're really drawing on is that gross margin number in the middle of your income statement. After your cost of sales, you look at all of your indirect expenses. And so those are, most of the money you spend on research and development is always going to be expensed. Again, the idea is companies undertake R&D because they're either trying to improve products or create new products. That money will hopefully generate value in the future. But in terms of financial accounting, that just gets recorded as an expense, since often since there are very little of R&D activities that can be capitalized in a balance sheet. And then the bigger piece of operating expenses are SG&A expenses. And so that's where most of us on this call, if you're in-house counsel, sit. So when people talk about, being overhead, most support functions, legal, finance, are all sitting as an overhead expense, although, your selling expenses are sitting there too. So you can, talk to your sales colleagues about that as well. And then, other big categories, insurance sits with SG&A, advertising or promotion of goods is sitting under selling expenses. And just, think about it, anything that's the general expenses required to run a business are all sitting under SG&A. In terms of looking at financial statement analysis, again, how much you're spending on SG&A expenses as compared to your gross margin is often closely measured and watched. And so again, this is a number that many companies are managing pretty closely. So you have your money you're taking in, direct costs, to produce that revenue, indirect costs to produce that revenue. And when you subtract your operating expenses and your cost of goods sold from your net sales, you then have operating income. And so the idea is that's kind of a broad measure of the money you've earned from running that business, including both your direct and your indirect expenses. From there, you may have, you may be paying taxes, or you may have tax provisions if you have a loss. You subtract that from your operating income to come up with a net income number. And then, once you determine your net income number, you can use that net income number and compare it to the number of shares you have outstanding, and that'll give you an earnings per share number. Earnings per share are usually reported in two ways. Basic will be your EPS based on the number of shares that are actually outstanding, and diluted earnings per share will take into account shares that are authorized but not issued. And so most often you'll see that with shares that are subject to a stock equity plan would come into that account. And so from a high level, you think about EPS as being the money left over for shareholders after the company has run its business for the entire year. When companies, if companies are public, if they're providing guidance to Wall Street, EPS is a closely followed number. So wanted to touch base quickly on, what is GAAP versus non-GAAP income. And so, again, this is a little bit more of an issue for public companies. The SEC has an interest in making sure that companies are reporting consistently and not trying to kind of monkey around too much with what they report out to the street about the health of their business. And so, from the SEC's perspective, the measure of a company's profitability is their net income. But when you think about it, there are lots of things that are in that income statement that don't necessarily represent cash expenses. And so many companies also report kind of a non-GAAP income measure, most typically earnings before interest and taxes. I kind of got pushed off the slide a little bit. The other piece that you'll hear about is EBITDA. So that's earnings before interest, taxes, depreciation, and amortization. And so again, if you're thinking about things that are hitting your income statement that don't necessarily correspond to money that a company is paying out, that's where you had depreciation or amortization of expenses. And then, because income and taxes are viewed as kind of non-operating expenses, companies will often report, an EBITDA number as a better measure of profitability, since it doesn't include those non-cash expenses. However, if you are reporting non-GAAP income measures or any non-GAAP measures as part of a financial release or kind of investor presentation, the SEC does require a reconciliation between one number to the next, so that, again, the idea is that companies don't want to be misleading about the nature of their profitability. This is just an example I pulled from Salesforce. Apple doesn't seem to publish any non-GAAP measures, which was kind of interesting, but lots of other companies, and I know companies particularly in the software space almost always do. And again, it's a more commonly used measurement of company valuation. But if you'll see these kind of reconciliations as part of a press release or an earnings release, again, this is all kind of required disclosure that will take you. You can get all these numbers from the balance sheet or income statement and reconcile from a GAAP number to a non-GAAP number. All right.
So we have a number of questions in the chat and a number of great discussions. So thank you to everybody who is participating in the chat. A few people are saying that the slides are cut off. It looks good for me. So maybe adjust your screen. And as well, you can download the slides. Sabrina made them available just now. So let's go through some quick questions, and then we'll go back to the program. Michael is asking, what is the difference between a capitalized and an uncapitalized asset?
So a capital, kind of has two meanings. For financial accounting purposes, a capitalized asset means that there's something you can recognize in your balance sheet. And so, right, cash is an asset that is capitalized. So, you do recognize it on your balance sheet. A brand value, the value of a brand is not something that you can recognize under financial accounting rules. And so that's a kind of a non-capital asset. From I think about it, it's like more of a building perspective, capital assets can also be like your property and your facilities are sometimes also referred to as a capital asset, but that's a little bit outside of the context of preparing financial reports.
Okay, got it. What is a cash equivalent?
Oh, I think can be converted into cash within 30 days. And so if you have kind of money market accounts, right? Money market accounts for many people are almost the same as cash. And so, it's something that can be quickly turned into cash. Anything that's like a stock wouldn't count, but it's mostly kind of, think about it as like, marketable securities or, money market accounts.
Got it. And then there was a lot of interest around intangible assets. Can they be capitalized? And people are wondering about trademarks and patents and, licensing IP, if you can talk about that generally.
So if you are a company and you are, creating a patent or creating a trademark, most of that kind of what I think about is the act of creation is really an R&D expense. And so your engineering, again, in the software context, your engineering team that's doing all the work to do coding, and maybe they come up with a new feature that can be patented. All of that money that they spent, their labor expenses, their materials expenses, all gets expensed as R&D. None of that really hits your balance sheet. You can capitalize and put on your balance sheet, pretty filing costs, again, which are pretty minimal. But the idea is, right, that team of people created a piece of software or whatever that IP is that will have some value that your company can go and sell in the future, but that's not going to be recorded on the balance sheet. One piece, I think I had a slide that I pulled on this, that you will see is goodwill. And so if you acquire another company, there's basically an exercise that says, if you pay $10 million for a company, but then you can, under accounting rules, if you can, combine the balance sheets or maybe bring on, say, $7 million of assets that come on your balance sheet, there's kind of still $3 million that's unaccounted for. And so if you are buying a company, that $3 million is then capitalized on your balance sheet as goodwill. And the idea is that's kind of the excess price you paid over the financial value of those assets. So in some ways, that is often, again, it's only created in the context of an acquisition, but that does kind of represent brand and goodwill and customer relationships that can't necessarily be recognized on a balance sheet. The thing about goodwill is that it has to also kind of be evaluated and potentially adjusted over time. And so there is a process of like assessing kind of the market value of that goodwill, which is really looking at kind of the results and the success of that acquisition. And at times that goodwill may need to be written down as well.
Got it. A few more questions and then we'll
Sure.
move on. How do you capitalize a patent portfolio that has been monetized and continues to obtain license revenue? Is it revenue recognition versus asset value?
So if you go out and acquire a patent portfolio, I guess, again, there's specific rules about how you can value those patents, when they become part of your corporate enterprise. Again, most of that is probably sitting under goodwill, but it can differ a little bit depending on what it is the nature of the portfolio and how you intend to use it going forward.
Okay, got it. Let's turn to our poll question. What are the main sections on a balance sheet? And it's interesting. I think, I guess, do you want to go over the results? So we have assets, liabilities, and income is one option. Assets, liabilities, and equity is another option. Assets, liabilities, expenses, and assets, gains, revenue. So that one is definitely not it. What is the correct answer?
your assets, liabilities, and equity. So
All
your
right.
assets are always going to be equal to your liabilities and your equity.
All right, and 61% of that got that right. I guess about 40% got it wrong. So luckily we're not back in
They
jail.
answered though.
They did answer, so
People are still
thank you
around.
for that. All right, back to you, Karen. We have definitely more questions, but we'll save that
Okay.
for the end of the program.
We'll go through cash flow statements and then wrap up, and then happy to take more questions too. All right. Last on our journey, cash flow statements. When people think about kind of, operating income or measures of profitability, often those get more used and more kind of published than cash flow statements. But cash flow statements, again, are an important measure of, how a company is, funding itself and whether it can fund itself from its own operations or not. So again, like the other two statements, there's also an equation that goes along with cash flow statements. You look at cash flow statements have kind of three categories. You look at your operating cash flows, so money you're coming in from your operations, your investing cash flows, money that you're either spending or taking in as investments, and then financing cash flows, again, money that you're using to help in or out to help finance your business. And when you add those three categories together, you will come up with your change in your cash balance. And so, your cash flow statement helps measure and demonstrate how the company is being funded. And similar to the income statement, it's covering a period of time between the two balance sheet dates, as opposed to a snapshot like your balance sheet does. So again, your operating activities are your core business operations. So those things kind of above the line on your income statement. So those are items like your revenue, your cost of goods sold, and other changes in your what are called kind of your working capital accounts. So your current assets, your current liabilities, your investing activities. So where operating activities are the day-to-day pieces of how you're running your business. Your investing activities are kind of longer term spending. So things like purchasing, property, plant, and equipment, or other investments you may be making. Sometimes you may be making investments in other companies or purchasing securities that have a longer term horizon. And then your financing activities are your cash you raise or you're repaying from debt or equity financing. And so, the reason why they are separated into these couple of categories is that it's meant to show whether the company is able to generate enough cash to run its operations on its own, or whether it's relying heavily on external funding to keep the business afloat. All right, here's our last cash flow statement from Apple. Cash flow statements always, there are two methods of doing cash flow statements. This is the indirect method. There's also a direct method. It's much more common to see an indirect method, and we'll talk about what that means. A direct method would just look a little bit different, where these are often comparing different balance sheet accounts. Direct method would have more kind of cash spent for operating versus investing activities. But what you most typically see is in cash flows statements prepared on an indirect method, that always will start with your net income number. And so, for operating cash flow, you take that net income number and then look at, things that were recorded as expenses that didn't involve any cash. And then you look at changes in your operating assets and liabilities. And so you can add back, non-cash expenses. So most typically those expenses will be, depreciation. So the amounts you wrote down your longer term assets, and also amortization, which is the same idea, but more attached to goodwill. And also share-based compensation expense, for those of us who work at companies that rely heavily on equity compensation, when companies give equity to their employees, again, there's no cash out the door. There's a whole set of, pretty fairly complicated rules around expenses that have to be recognized to recognize, what it does cost the company to issue those shares. That, in terms of operating cash flows, gets added back as a non-cash expense. Then you can look at all the changes in your operating assets and liabilities. Again, if your account receivable balances go up from one period to the next, that often means that you're owed more money, and so maybe your cash has gone down, and you kind of go through your different operating assets and liabilities, and really you can check these. You could go back to the balance sheet and compare from one period to the next, and that would be the difference. So you take all those pluses and minuses, and you get to your number that's the cash generated by operating activities. You then look at investing activities. So again, these are things that you're purchasing or proceeds of often proceeds of securities that have certain that are called marketable securities. That has a whole bunch of ins and outs to a net balance for your investing activities. And then your financing activities, again, are more related to stock and debt issuances. And so payment, again, if you pay dividends, that sits under our financing activities. If you've issued debt or you repaid debt, all of those numbers come through as your financing activities. And then if you take the three categories, add those three together, that'll get your increase or decrease in your cash. And that again has to measure up against the change in your cash balance that's sitting on your balance sheet. Okay, we're getting towards the end. Just highlights on some very quick topics. Management discussion and analysis. MD&A again is an important part of financial statements that are produced for the SEC. But regardless of whether you're a public company or not, almost all financial statements will have footnotes. Both footnotes and MD&A have more kind of textual analysis, and so it's often amounts pulled from those sheets and further explanation. Maybe some more details about what comprises of an account. You'll have information about estimates. And again, a little bit more as opposed to just looking at the numbers on financial statements. It's more of a written explanation of how those financial statements have changed over time or where they are as reported. There are, what we think about is kind of three main types of financial statement notes. The first is a review of significant accounting policies. And so again, FASB and the SEC have a lot of rules around how accounting standards have to be reflected in financial statements, but there is still room for judgment. And there's also kind of room, depending on industries, on how those get applied. And that all gets summarized in the accounting policies section. As kind of new policies come out, companies also have to usually address how that will affect their financial reporting as well. There are a bunch of financial statement notes that are what I think about as kind of like more information or more details about accounts that are recorded. And so you'll have a whole lot of information around tax provisions, whether there's deferred tax assets or liabilities, information about inventory, again, more detailed balances or description of what's in those accounts. And if you do have kind of goodwill, again, there'll be more description about how that goodwill is created, how that valuation was done to determine if it has to be written down, and just kind of an understanding of how that number is calculated. And then the final category of financial statement notes, or what do I think about, is more kind of indirect information. And so that's information around maybe your commitments and contingencies. So some of those may not be reflected in your financial statements, but again, is good information for investors or to know. Information about stock compensation plans fits in that category too. When we think back to kind of our principles, having all that information that's material to an investor, a lot of that indirect information is kind of, may not be directly reflected in a financial statement, but is good information for people making an assessment of the financial state of a company. I'm not going to cover this too quickly, but once you know and understand how these financial statements work and how they compare against each other, you then can create a whole bunch of ratios to compare one company to another. And so, comparing a company that's you may be able to compare companies in the same industry that maybe have different size or different scale, and so it's hard to compare them just outright. But if you use these ratios, it makes the comparison more easy to perform, as well as kind of all these key ratios kind of get measured over time as kind of a trend analysis. And then finally, why do we care about any of this? How can this help you, be a better partner to your organization? First, it's really important to understand your company's financial health. How are they making money? Where are they making money? how and where do they need financing? Where's all the money coming from day to day, as well as on the long term, strategic ideas. Often attorneys also get, closely involved with doing, debt or equity financing. And so, right, there's a whole, practice and people that are experts in doing the documentation around financing investments. But it's really important to know, how those investments and how that financing is going to be reflected in your financial statements, because again, the drafting can matter. The next piece we talked a little bit about, is assessing litigation exposure. To the extent your company is subject to any litigation, how and when you have to either disclose, the potential loss associated with the litigation, or potentially accrue an expense, really kind of comes down to a legal decision. And so it's important to know kind of, what the characteristics, and not to only have a good understanding of the suit you're dealing with, but also how the accounting regulations overlay those to kind of have, productive conversations with the finance teams. And then, a lot of the rules and regulations around how financial statements are compiled and reported is because people like to, play tricks with them. And so, it's important to know where things have judgment, where things, what things need to be reported or not reported. And, as part of kind of a, both as a compliance as a risk management team, it's important to know kind of where things can go off the rails, or, perhaps potentially misreported, to help make assessments and help guide the organization in the right direction. And then, general support for commercial transactions. We see that every day, kind of if you're doing kind of, working with your sales team, helping to draft contracts, coming up with good templates. If you're buying companies or selling companies, again, a lot of those decisions on how contracts are written and, really can make a difference on what can be reported or recognized in financial statements. And so it's important to know the implications often of what you're drafting. And then very high level takeaways. If you remember anything else that we talked about today, accrual basis of accounting. Again, you're not always following the cash. You're following what can often be a fairly set of complicated rules about when you record revenue, when you recognize expenses, what type of assets you can record. Your three main statements are your balance sheet, income statement, and cash flow statement. They together are meant to kind of be viewed together to provide a comprehensive view of the company's health. And then, you refer back to some of those kind of accounting equations, that ask what a balance sheet is, what an income statement is, what your cash flow statement is. You can think about those kind of high level equations. It's a good way to help kind of set the stage of, making an assessment of what else is reported. All right, I think that's it, Shai.
All right. Thank you so much, Cara, for a wonderful presentation. There are, again, a ton of great questions, so we'll go there. Folks, if you enjoyed the program, and thank you, Nathan. If you enjoyed the program, tell us in the chat. Again, Cara is a 100% volunteer and taking time out of her busy schedule to do this. So we really appreciate you. Thank you so much. Again, folks, if this was a good presentation, if you enjoyed it, let Cara know in the chat. So here's some more questions. Can you explain, again, what is the direct method of cash flow? What does that look like?
The investing and the financing section are largely the same. What's different is your operating expenses. And so, right, where an indirect method that, again, is you see almost always, you can take your current assets on your balance sheet and basically calculate that yourself. One way to think about it is, if you have a balance sheet and an income statement, you should be able to come up with a operating cash flow statement on your own if you get bored or can't sleep at night. So, my camera's looking out. A direct would just, it's basically, cash received from revenue, cash expenses. And so it's more, you can't take those numbers directly from your balance sheet. It's just a different method of presentation.
Okay. Above the line and below the line, what does that mean?
So when we were looking at an income statement, things that are, above the line, or that kind of that gross margin line up. And so that's, again, the basic measure of profitability for the goods that you're selling. And below the line, again, is everything, your indirect expenses and your SG&A expenses. sometimes, again, with the other thing that people think about is some of those SG&A expenses are those non-cash expenses. And so when people are using an income statement to, sorry for that. Yeah, they'll add back those non-cash expenses to kind of come up with a measure of profitability.
What does finance look to determine if they will be able to make payroll, pay rent, and utilities at the end of the month? Like, let's say you're an emerging but not yet profitable company.
Mm-hmm. And so we didn't have much time to talk on it today, but there's a bunch of ratios that finance teams look at. Most common, one that's very common is a working capital ratio or a working capital number. And so working capital is your current assets minus your current liabilities. And so if that number is negative, you probably don't have enough cash to fund those liabilities you have immediately owing. But I think that's the most common. Working capital can be that number or that kind of percentage ratio is the most common for can the business make payroll and pay its AP expenses.
Got it. Switching gears slightly, if you have a subscription agreement for a license with a 12-month term, can't you recognize the revenue as each month passes? Like, can't you amortize it over 12 months?
Yes, and so if you're selling kind of subscription services, you typically invoice for those services up front, and you may get that cash, and you may get that cash kind of at the beginning of the subscription period. And so you'd record that cash, but you're also recording deferred revenue because you can't recognize that revenue until the services are performed. Most typically, companies will do that on a monthly basis.
Got it. How do you reconcile the differences in accounting principles if you're reviewing records with different accounting periods to your company as part of an M&A? So I guess, one company uses one principle, one company uses another set of principles.
Yeah, and so even though there's a ton of principles, there's lots of variation to some of those principles, and some, again, how the biggest piece you might see is how and when revenue gets recorded, and sometimes some revenue gets recorded kind of net or not. I generally rely on forensic accountants who are coming in to kind of do a financial statement analysis, and a piece of it is just helping to understand, reading those accounting footnotes about the summary of accounting principles to help make an assessment of what can be different. There's also a difference, when you acquire a company, you don't necessarily just take their balance sheet and add it to your balance sheet. Often, some assets may need to be written down. They kind of can't be fully recognized. And so there's kind of a whole methodology to when you acquire a company, what that, integration accounting looks like.
Got it. A few more. Any tips on how to recognize revenue and calculate contract revenue to provide numbers to finance? Is this done by a legal member on your team, or would a contract management system help, or does finance get this, separate from the legal team?
My opinion is that that's something that your finance team should take responsibility for, right? The legal team should be in charge of contract drafting, making sure that contract terms are accurate and kind of reflect the commercial realities. How that actually gets translated into revenue recognition is something that really should sit with the finance function.
All right.
That being said, they often need explanation. Sometimes they need help translating what a contract says or what things mean. And so, but the actual decision should probably sit with finance.
Yeah, definitely. All right. I think this is going to be our last question. And again, thank you so much, Cara, for a wonderful program and, just for taking the time out of your schedule for this.
Welcome.
Can you explain what debt financing is and highlight what the debt to equity ratio and debt to assets show?
Mm-hmm. So again, your debt to equity ratio is, again, common financial ratio that you'll measure over time. And really it will look at how is a business getting funded? Is a business, going out to outside investors and selling long-term equity, or are they using debt, right? And so equity is a long-term commitment to a shareholder. You're, selling away a piece of your company, essentially. Debt can be short or long-term, but you're not technically giving away part of your enterprise value. Right? There's a whole science or an art to how much debt you should be using to finance your company. That's really highly industry dependent and can be dependent on interest rates and what makes the most sense. But that ratio of how much debt you have outstanding versus how much equity you have outstanding is pretty closely watched in terms of when you think about the long-term strategic goals of how you want to grow a business.
All right. Got it. Thank you so much, Cara, and thank you everybody for tuning in. Thank you for your wonderful participation. Chat box was super, super active. A lot of great questions, and this was wonderful. Cara did a great job.
Thank
Thank you
you.
again. I hope everybody has a wonderful, happy holidays, Merry Christmas, Happy New Year.